what if I told you that a public company could report record-breaking billion-dollar profits on a Friday, right?
Yeah.
And then they officially file for bankruptcy on a Monday.
It sounds completely impossible.
Right. I mean, maybe even illegal, but it happens. And it happens because the numbers we see in the headlines, they're often telling a completely different story than the actual cash sitting in the corporate bank account.
Oh, absolutely. It's a massive disconnect.
Welcome to this deep dive. We are unpacking the actual mechanics of how businesses measure reality. And for this, we're using the foundational guide, Essentials of Financial Accounting, Principles and Reporting Standards.
It's such a great source.
It really is. Okay,
Yeah.
let's unpack this. Because for anyone running a business, investing capital, or, just trying to understand how the global economy doesn't collapse under its own weight.
Right. Which is a miracle sometimes.
Seriously, we need to decode this architecture.
We really do. I mean, financial accounting operates as this highly standardized translation mechanism.
Yeah.
It is basically a systematic process. It's designed to take the chaotic, messy, just day-to-day operations of a business and convert them into a universal language.
So taking all that noise and making it readable.
Exactly. It takes millions of disparate actions, like a sale in Tokyo, a machine breaking down in Ohio, maybe a software subscription renewed in London, and it forces them through this standardized framework.
So that an external observer can actually gauge the entity's financial position.
Yes, exactly. But, to understand what it is, we first have to understand who it's for.
Right, because the framework itself has a very specific audience, and that dictates how the rules are written. The source draws a hard dividing line between internal reporting and external reporting.
Yep, managerial accounting versus financial accounting.
Which is such a crucial distinction. Let's get into that.
That division is really the core of how a modern corporation functions. So managerial accounting is completely internal. It's like the tactical dashboard used by executives to make immediate strategic decisions.
It's the messy behind-the-scenes stuff.
Totally. It doesn't have to look pretty, and it definitely doesn't have to follow international laws. It just has to be useful for them.
Whereas financial accounting has a strictly external focus.
Right. It is built for the public,
Wow.
the regulators, the investors, which means it has to be rigidly standardized.
Let's talk about how that internal managerial side actually operates mechanically, because I think it highlights why the external side has to be so rigid.
Yeah, that makes sense.
Let's look at cost accounting, like the text mentions. Say a factory manager needs to decide whether to switch to a cheaper raw material to manufacture a product.
Okay, classic problem.
Right. To make that call, they dive into their managerial accounting system and track these highly granular metrics. We're talking variable costs, fixed costs, factory overhead.
They are literally allocating the specific electricity cost of a single machine to a single unit of inventory.
Just to figure out their exact margin.
And based on that hyper-specific internal cost tracking, they might realize that a cheaper raw material actually slows down the machine.
Oh, which increases the overhead electricity cost.
Exactly, thereby completely wiping out the savings. That is a brilliant, necessary insight for running a factory floor.
But you cannot hand that disorganized, internally customized spreadsheet to a Wall Street analyst.
No, you absolutely cannot.
But I like to think of it this way. Financial accounting is kind of like dressing up in a sharp suit for a job interview, right?
I like that.
And managerial accounting is like wearing sweatpants at your desk while you're furiously trying to figure out how to afford groceries.
That is painfully accurate, yes.
But here's my pushback on that. If I'm an investor, shouldn't I want the raw, unfiltered reality? If managerial accounting gives management the better, smarter insights for decision-making,
Yeah.
why are companies forced to use a totally different, highly rigid system for the public?
Well, because your unfiltered reality is going to look completely different from your competitor's unfiltered reality.
Ah, I see.
If every company reported their finances using their own unique internal metrics, an investor would never be able to accurately compare, say, a tech startup in Silicon Valley with a manufacturing plant in Ohio.
It's the whole apples to oranges problem.
Exactly. You need a universal baseline. That is why public companies in the U.S. are bound by GAAP.
Generally accepted accounting principles.
Right. And internationally, they adhere to IFRS, the International Financial Reporting Standards. These public frameworks aren't about providing internal strategy.
They are about decreasing risk.
Yes, decreasing risk, promoting trust, and ensuring absolute apples-to-apples consistency across different companies, for external stakeholders.
Okay, so if financial accounting is a universal baseline designed to create comparability, it has to aggressively standardize the concept of time, right?
Absolutely.
It has to decide exactly when a transaction is, officially acknowledged by the universe. And that forces a company to choose between the cash method and the accrual method.
And this is where it gets fun. The timeline of money is where business reality often splits from physical reality. The difference between those two methods boils down to the exact mechanism that triggers a journal entry.
The cash method is what most of us use in our personal lives, I think.
Yeah, pretty much.
Transactions are recorded only when physical cash actually changes hands. You recognize revenue when the dollar hits your bank account. You recognize an expense when the check clears.
It's mechanical, it's physical, and it is usually reserved for smaller private companies with no external reporting demands.
It basically strips a company's operations down to its physical bank balance. But the accrual method, which is mandated for larger public companies,
It completely decouples the recording of a transaction from the movement of cash. Under the accrual method, you record revenue when a benefit is received or earned, and you record an expense when a liability is incurred.
let's walk through the mechanics of that because it requires a bit of a psychological shift.
Let's do it.
Okay, let's use the text's example. Say I run a consulting firm. A client wires me $1,000 today for a project I am going to execute for them next month.
Okay, so you have the cash right now.
Right. Under the cash method, my bank account is up $1,000, so I record $1,000 of revenue today. Simple. But under the accrual method, that cash in my hand is technically a burden.
It is a massive burden.
Yeah.
You have the cash, but you haven't actually performed the work yet.
Right.
Therefore, you haven't earned the income. In the accrual system, you record a debit to your cash account because, the money is physically there.
Yeah, I'm holding it.
But simultaneously, you must record a credit to a liability account called unearned revenue. You are literally recording that cash as a debt.
Wow. Because I owe them the work.
Exactly. You owe that client either the consulting work or you owe them their money back. It's only next month, once the work is actually finalized, that you extinguish that liability and finally recognize it as actual revenue on your books.
That's wild. And the mechanism works the exact same way in reverse for expenses, right?
It does. Let's look at the utility bill example.
Okay, let's say my firm receives a $5,000 invoice in July for the electricity we used that month. But I drag my feet and I don't actually write the check until August.
Typical business move.
Right. Now, the cash method says the expense happened in August when the money actually left my account. But the accrual method forces me to record that expense in July.
Yes. You debit your utility expense for July and you credit your accounts payable, acknowledging the debt.
And when August rolls around and I pay it, I'm simply clearing the debt, not incurring a new expense.
Exactly. Now, I know the cash method might feel more honest to people because you can literally touch the money.
Wait, yeah, if I have $1,000 in my hand right now, why can't I call it revenue? Isn't the cash method just more honest? So what does this all mean?
Well, it seems more honest, but the accrual method actually depicts a much more realistic, accurate timeline of a business's operational health.
How so?
It matches the effort to the reward. Think about it. If you record that $1,000 consulting fee in month 1, but you incur all the payroll costs to actually do the work in month 2,
Oh, I see.
your business looks artificially, wildly profitable in month 1 and like a catastrophic failure in month 2. The accrual method smooths out that distortion.
Okay, but the moment you decouple the recognition of revenue from the physical movement of cash, you open the door to extreme manipulation.
You really do.
I mean, if I don't need cash in hand to claim I made a sale, what stops an aggressive CEO from just declaring massive amounts of unearned revenue to juice the quarterly numbers?
That exact vulnerability is why the accrual system requires a structural cage.
Structural cage. I like that.
Yeah, without strict guardrails, accrual accounting would just be corporate fiction. And those guardrails take the form of 5 core accounting principles.
The 5 pillars.
Right. If a company deviates from these pillars, their financial statements are fundamentally invalid.
So the first barrier in that cage is the revenue recognition principle. It sounds simple, but it is aggressively debated in the corporate world. Revenue can only be recognized when it has been strictly earned.
And earned is the operative word here. For a company selling a physical product, it's easy. Revenue is recognized when the product ships and the risk of ownership transfers to the buyer.
Sure, you ship a pair of shoes, you earn the money.
Exactly. But think about modern software as a service companies. If someone pays upfront for a 3-year software license, the company cannot recognize all that revenue on day one.
Oh, right, because they haven't provided the service for 3 years yet.
Right. They have to recognize it fractionally over 36 months
Hmm.
because they haven't earned the back half of that contract until they actually provide the server uptime 2 years from now.
Which perfectly sets up the matching principle. We touched on the mechanism of this earlier with the utility bill. You have to match the expense to the exact same period that you recognize the revenue it helped generate.
That's the one.
It's exactly like tracking calories on a diet. You can't eat a massive cheeseburger on Tuesday, wait a month to log the calories, and pretend your diet was going perfectly on Tuesday.
That is a great analogy.
You have to match the physical consequence to the exact day the action occurred.
Yeah, a failure to match creates a completely fraudulent picture of profitability.
Yeah.
If you recognize a massive software sale today, but push the server and developer costs into next year's reporting, your current margins look artificially inflated.
Then we hit the problem of valuation, which brings us to the cost principle. How do you decide what the assets on your books are actually worth?
Right.
The cost principle dictates that assets and liabilities are recorded at their original transaction cost.
And this creates a fascinating friction. Let's use the text's specific example. Say a company buys a depreciable asset, like a warehouse, for $1 million.
Okay.
10 years later, the real estate market booms, and that warehouse is genuinely worth $5 million.
Wow, great investment.
But under the strictest application of the cost principle, that warehouse largely stays on the books based on its historical cost, and it's expensed over its useful life. You do not just constantly mark it up to whatever you feel the current market value is.
But doesn't that make the company's financial statements inherently inaccurate over time? I mean, they are sitting on a $5 million asset that looks like a $1 million asset on paper.
It absolutely creates a distortion in current value, but it is a necessary trade-off to satisfy another pillar, which is the objectivity principle.
Right, objectivity.
Financial accounting must be based on verifiable facts and evidence, completely free from management's bias. Historical transaction cost is a cold, hard fact backed by a receipt.
And fair market value is just an opinion.
Exactly. If managers were allowed to constantly revalue their own assets based on, like, market vibes.
Oh man, every company would miraculously discover their real estate was worth triple right before an earnings call.
Exactly. Which leads directly into the full disclosure principle. Because these rules create unavoidable blind spots, like a warehouse being undervalued on paper, a company is required to provide complete, transparent reporting.
This happens in the footnotes, right? Or the schedules and commentary.
Yes. The numbers don't exist in a vacuum. The footnotes explain the exact accounting policies and risks that shape those numbers. What's fascinating here is how these 5 rules work together to lock down reality.
They really do interlock.
Yeah, they govern the timeline, they anchor the dollar amounts to objective facts, and they force transparency when the rules fall short. It ensures that an accrual-based report is an objective, transparent reflection of the business.
So with the rules and the timelines firmly established, we can finally look at the actual end products. The 4 essential financial statements that every public company must generate. These are the 4 windows into a company. Let's start with the balance sheet.
The balance sheet is entirely unique because it does not represent a period of time. It is a freeze-frame snapshot of a single specific date at the end of a reporting period.
It's like taking a photograph.
Exactly. It shows
Yeah.
exactly what the company owns, which are assets, what it owes to others, its liabilities, and the residual value left over for the owners, the equity.
And we can extract immediate operational intelligence from this snapshot. Let's take a specific metric from the text, the current ratio.
Oh, that's a crucial one.
You calculate it by taking a company's current assets, like cash and inventory that can be liquidated within a year, and dividing them by their current liabilities, which are the debts they have to pay within that same year.
Mechanically, it checks short-term debt solvency. It measures short-term survival. If a company has a current ratio of 1.5, it means they have $1.50 in liquid assets for every $1 of debt due imminently.
They can comfortably keep the lights on.
But if that ratio drops to 0.8, they do not have enough cash to pay tomorrow's bills. They are in a severe liquidity crisis, regardless of how strong their brand is.
The second window shifts from a snapshot to a video. The income statement, or the P&L, it records the operating activity over a specific period, like a quarter or a year.
It starts with top-line revenue, deducts the expenses, until you are left with the bottom line, net income. It tells the narrative of the business model.
But wait, if the income statement shows whether a company is profitable, why do we even need the cash flow statement? Shouldn't profit equal cash?
You would think so, right? But this is where the accrual blind spot comes in. Because of the accrual method we discussed earlier, a company can look highly profitable on paper, on the income statement, while simultaneously running out of actual money to pay its bills.
Ah, because they recorded revenue they haven't been paid for yet.
Exactly. That naturally forces us to create a completely separate document just to track physical reality, which is the cash flow statement.
Okay, so the text notes this clears up the cloudiness of accrual accounting.
It really does. It tracks actual cash usage across three categories:
Right.
operations, financing, and investments. Did more physical cash enter the bank accounts than left?
Got it. And then the fourth and final window is the statement of shareholders' equity.
Yes. This document bridges the gap between the income statement and the balance sheet. It shows the changing residual value of the company over time.
Like share capital, net income, dividends, and retained earnings.
Exactly. It breaks down the components of ownership.
So we have these four highly complex, strictly governed documents: the balance sheet, the income statement, the cash flow statement, and the statement of shareholders' equity. The architecture is massive, which begs the question, who is actually demanding to read them at a granular level?
Well, the ecosystem of users is deeply interconnected. You have investors setting their expectations. You have auditors checking for misstatements.
And regulatory agencies, right, like the SEC.
Yeah, absolutely. The SEC enforces compliance under threat of massive federal fines or even delisting from the stock exchange.
And banks use them to embed strict loan covenants or determine interest rates.
Yes, but one of the most critical users of this data are a company's own suppliers.
Here's where it gets really interesting. We always think of Wall Street investors poring over these documents, but a company just trying to buy raw materials from a vendor has to prove its financial health first.
Exactly. The supply chain runs on credit. And the source points out a specific detail here. Suppliers might calculate a Piotrowski score from these statements before extending credit.
Oh, I love the Piotrowski score.
It's a brilliant mechanism. It's a 9-point checklist calculated directly from a company's financial statements. If a company scores an 8 or 9, they are rock solid. The supplier ships the materials.
But if they score a 2 or a 3, they are showing severe distress. The supplier demands cash up front.
If we connect this to the bigger picture, these standardized statements aren't just bureaucratic paperwork. They are the vital trust-building mechanisms that allow the entire global economy to function.
Which means we need a network of certified professionals to act as the guardians of this data.
We do. And the architecture of that guardianship is structured around very specific certifications. In the U.S., the ultimate standard rests with the CPA, the Certified Public Accountant.
And internationally, you have the chartered accountant, or CA, playing a parallel role.
Exactly. Then you have the CMA, the Certified Management Accountant, who handles the management and financial analysis on the inside.
And acting as the internal police force is the CIA, the Certified Internal Auditor. They oversee the internal control environments.
It's a system of checks and balances designed to eliminate bias and error before the data ever reaches the public market.
Okay, as we wrap up this deep dive, you, the listener, are now armed with the foundational knowledge to look at a company's financial statements not as a wall of confusing math, but as a transparent story about its past, present, and future health.
You really are. It is a remarkably tight, logical system. But before we go, I want to leave you with a final puzzle to mull over.
Ooh, okay. What is it?
We established that the source material's objectivity principle demands that statements be completely factual and free of bias, right?
Right, based on hard evidence.
But it also quietly admits that financial accounting requires estimation and professional judgment.
Oh, right, like guessing the useful life of an asset.
Exactly. When you apply the class principle and record a depreciable asset, a human being has to make an educated guess about how long that asset will last.
Wow, yeah.
So I'd ask you to ponder this. If the bedrock of financial reporting, this system that triggers billions of dollars in global investments, still relies on human estimation.
Where does the objectivity actually end?
Exactly. How much of a company's objective reality is actually just a highly structured, legally approved opinion?
That is a fascinating thought to end on.
The rules dictate the language, but the human element will always influence the translation. Keep that in mind the next time you review a balance sheet.